welcome. I appreciate you being here. Thank you for taking the time to watch the video. This video today is a video that I am making because I was looking at my 401k the other day and I was feeling pretty depressed about it. Then I did something that gave me some inspiration and kept me motivated, and I thought that I would share that same inspiration with you. Spoiler alert, this video is about a portfolio run-up. Have you ever heard of the term bull trap? A bull trap is a false signal that shows that a decline either in a stock or in the market in general is ending and that a rally is coming. This is common among investors who trade frequently, active traders, particularly people who believe in charts and technicals and read charts and try to predict what's going to happen. The trap part of the bull trap refers to the fact that people are actually getting tricked because they get this false sense of security that a decline is over. They act on what they think is a rally that's coming up. It results in a negative outcome and they end up with losses. These days, investors do have a lot to be concerned about. We have historically high inflation, and the latest CPI data, which is the consumer price index, is very high at 7.9%. We are also facing geopolitical tension because Russia decided to invade the Ukraine, and those political tensions, of course, have economic ramifications on us. All the Western countries are putting sanctions against Russian imports, which is resulting in raising prices. We can't ignore the fact that there is a possibility of a world war if NATO does decide to enter the conflict. As if that's not bad enough, we're looking at unsustainable housing prices because the median house price right now is far out of reach for most buyers. In 2021, the median house price across the entire country was $375,000. To me, that sounds like a bargain, but that's also because I am from a high cost of living city where the median price in my city in 2021 was actually $800,000. You see, a bargain is relative. House prices are going up so fast. Between 2020 and 2021, they were up 16%. And if you look at the data over a much longer period of time, between 1980 and 2020, really it was up 416%. But does any of this matter? And the answer is no. All of this is irrelevant. You're probably wondering, why would any of this be irrelevant in the grand scheme of things? Let's talk about another saying. Have you ever heard of the saying, time in the market beats timing the market? If you haven't heard of this saying, let me tell you what it is. It's pretty self-explanatory, but I am going to confirm your feelings. It means the longer you stay invested, you are much likely to perform better than somebody who is trying to beat average market returns. Someone who tries to figure out the exact bottom of the market where they can buy and figure out the top of the market where they should sell is most likely going to be doing much worse than you, because no one can predict what is going to happen next. Even if we could predict what was going to happen, there are way too many things that influence the market in the first place. And sometimes things don't influence them the way we think they will. COVID is a great example of that. We have this virus that is going around infecting and killing millions of people around the world. You would think this would lead to an economic collapse of catastrophic proportion, but instead we have this huge rally. Housing prices are going up when you would assume that people would be nervous about spending money when the economy was shut down for so long. You can't predict everything, and even when you do try to predict something, you have to be right twice. You not only have to be right when you're guessing the bottom of the market, you also have to be right when you're guessing the top of the market. If time in the market is what leads to success, how do you measure it? I have found out that the best way to measure success is to zoom out. Zoom out on those charts. When you're looking at them too closely and you are way zoomed in, it is very easy to get depressed because the market is relatively volatile from day to day. Time, ideally many years, is what's going to be in your favor. And how do you ensure success? Is through diversification. 10 to 15 tech stocks is not diversification. True diversification comes from hundreds, if not thousands of stocks. That means the S&P 500 index, the total US stock market, the total world stock market. That's how you ensure success. Now on to my story. My story starts in 2013. That's not when I started investing. If you are enjoying this video so far, don't forget to hit the like button so the algorithm knows that it's good. And of course, subscribe for more content. If you think any of the information that I provide here might be helpful to somebody else, be sure to share it with them. But that is when I started investing in the plan that we're going to look at today. I actually started investing in 2007. I left my employer and rolled that money over into an IRA. If you want to know my story about how I handled that IRA, you can look at my video on Merrill Edge guided investing because I discussed that a little bit. But more specifically, this particular employer-sponsored plan is the one that I have contributed to consistently since 2013. That's why we're talking about it. If we do a look back, in 2013, I did not contribute anything between January and October. The market was down, but I was also nervous about my own personal economic situation. I was in the middle of a job change where I had just started working for a new employer. I did not know if I was going to like it. I did not know if they were going to like me. I had also made a big financial move. I had bought my first house as a single person on a single income. I put 20% down payment, which was a huge accomplishment, but that also meant I depleted my savings. I was very eager to get my cash back to where I was comfortable. Because of that, I decided to forego retirement contributions. At the beginning of November in that year, when I felt much more comfortable with my financial situation, I was performing well at work, and I had started building my savings back up, I decided to contribute. I was contributing very small amounts over time with raises. From 2013 to 2020, I was gradually increasing my contributions. And starting in 2021, I was able to max them out for the first time. In the past, my asset allocation has been all over the place. It's pretty embarrassing. I might even make a video about that in the future, but fortunately, I eventually got my life together. And since then, I've decided to build a portfolio that matches my risk appetite and my personal risk profile. If you want to know more about how you can discover what your personal risk appetite is, I have a video on that I can link in the description box below. As far as asset allocation, now that it's no longer embarrassing, I can share it with the world. Currently, this is the asset allocation that I have for myself as well as my husband. I'm going to provide you with the Vanguard equivalent of what the tickers are. Neither one of our 401ks is with Vanguard. I figured that it didn't really make sense for me to tell you specifically what my own ticker is because you may not recognize it. Since Vanguard is incredibly popular, it's probably more likely that you're either familiar with it or that you may be able to find information on it. The largest fund in my 401k right now is the S&P 500 index fund at 65% of my total portfolio. The Vanguard ticker for that is VOO. The second largest is the Russell 2000 index fund that is considered US small cap stock, and the Vanguard equivalent is VTWO. That is the ticker for the ETF, and it represents 20% of my portfolio. And then the smallest one at 15% non-US stock, with the Vanguard equivalent being VXUS. As you can see, I don't have any bond allocation right now in my portfolio. That's because I have a more aggressive strategy based on my personal risk profile. At this time, I don't think bonds are necessary. Outside of the I bonds that I use for my emergency fund, I don't have any other bonds in my portfolio, and neither does my spouse. If you want more information on how I'm using I bonds, I also have a video on that I can link in the description box below. So here's the whole reason why we're talking about this today. I was looking at my account and I was relatively discouraged by the year-to-date performance. As you know, the markets have been a crapshoot and I have been hit hard. So far this year, I have contributed over $7,000 to my retirement account, but it was mostly down. At some point, I looked at my account and I was up only $2,000 for the year. $2,000 might not sound bad for the first 3 months of the year, but if you consider the fact that I put in $7,000, being up $2,000 is actually pretty bad because it means that I actually lost $5,000. If you're wondering how in the world I have $7,000 in only 3 months into the year, that is because I am choosing to front load my contributions. I have no penalties if I do it that way. My employer does not match my contributions. I don't have to worry about missing out on a match. If time in the market beats timing the market, it is in my benefit to put as much money as early as possible. At this point, I am effectively contributing $1,280 every pay period. While I was feeling down, a little birdie whispered in my ear and told me to zoom out. And when I did, it put everything in perspective for me. Look at this run up. How beautiful is this? This is almost the equivalent of a completely vertical line. As you can see, there was a small dip in 2018, and then there was the dip in the COVID crash. Throughout COVID, I never stopped investing, but I was nervous. nervous to the point where I was considering deleting the app from my phone because I didn't want to look at my account. But that's the thing about the market. Stocks crash, but the market goes up. And the day the market stops going up, none of this matters anyway. So why do I care? I didn't know where we would end up with COVID. COVID might have been over in a matter of months, which it was, or we might have had a lost decade situation. The impact of this could have been felt for years, but that wasn't the case. If I had stopped investing, I would have regretted it. This is what I mean by zooming out. If you look very closely at this and you look at the year-to-date period, it looks pretty bad. But overall, in the span of less than 10 years, I am up and I have decades to go. So what is the lesson here? The lesson here is stay the course. Whether you do the S&P 500, whether you do the world equities, whether you decide to do the total US stock market, no matter what you do, never stop investing. If you've made it this far, thank you for watching. I appreciate it. Of course, I always want to hear from you. Please leave me a note in the comment section below and let me know what your experience is like with investing. Are you a seasoned investor with a lot of experience? If so, is there anything that you would change about your strategy knowing what you know now? Are you a new investor? Do you feel a lot of nervousness about the level of volatility in the markets? And what investment style do you follow? Do you jump in and out of the markets, or are you a long-term investor? Leave me a note in the comment section about everything that is related to investing. I would love to hear from you. I'll see you in the next one.